Hello and welcome to the Income Ave podcast, navigating the bond market. With all the ups and downs in the stock market this year, Matt, let's kind of dig into what's happened in the bond market, where there might be value, how we're positioning, and kind of some thinking with the Federal Reserve changes coming as well.
Sounds good. So, first, let's start off with changes in the Federal Reserve. First and foremost, on Wednesday, Kevin Warsh was officially confirmed by the Senate to be the next chair of the Federal Reserve. During his confirmation hearings, we received some additional insight and several of his policy views and objectives, but a lot of details are still lacking and remain unclear. One thing that was clear, though, in the hearing is that he believes the Federal Reserve has drifted from its original mandate, and we can expect some meaningful operational changes when he comes in. He discussed a couple of them, such as moving away from forward guidance. This is the when the Fed comes out and tries to give the market and the public a rate path, and also where they see the economy going over the next couple of months and quarters. This is most widely used in the SEP, the Summary of Economic Projections, which include the dot plot.
Hey, Matt, this is kind of throwback to Alan Greenspan days, right? It was kind of more his philosophy on central banking policy, huh? Where you don't have as much conversation, kind of a shift more under, Bernanke, I think, with a lot of this, but kind of throw back to Alan Greenspan, I guess.
Yeah, exactly. So Bernanke really used the forward guidance, especially during the Great Financial Crisis, to kind of guide the markets on what the Fed's expectations were and how they're going to, what their reaction function was going to be. So it really, really came through during the Bernanke era. And Kevin Warsh he hasn't been favorable of that for a long time. So it's not a surprise that he wants to move from the forward guidance at all. Another thing that he discussed was reconfiguring how inflation is calculated. One thing he did throw out there was to, look at the monthly numbers and take out the outliers of those monthly numbers to get a better underlying view of where inflation is and the trends in inflation. Um, one
So
of the
how would that work, Matt? What's kind of general thought?
The way I interpret it, at least, is that if you look at the monthly inflation readings, there's numerous categories, be it apparel, used cars, new cars, airplane tickets, everything. So ideally, what I would expect is that if you had a pretty big number in one of those subsectors, such as airline fares increased
So,
10%.
for example, Spirit just went out of business, maybe 1 month, there's a big jump in prices.
You get the discount carry out. They have a big jump in prices in Spirit and airline fares because of that. So let's say fares go up 10% and apparel prices or used cars go down 10%. They would just say, okay, let's just ignore those for this month and look at the rest of the inflation picture with the other subsectors in there. Is how I would interpret it, I guess. But he wasn't, he threw that out there. Once again, a lot of this is to be seen on how he actually implements some of these things. And then the one of the last points was he wants more coordination with the Treasury. How this looks going forward is still unclear, but it's his belief that the Treasury and the Federal Reserve could do a better job of coordinating. We have a couple ideas on how that might work. But once again, there's nothing definite from Kevin Warsh as of right now. The big thing that did come out of this meeting, though, is that the one-time inflation hawk, Kevin Warsh, he is now in favor of lowering the Fed funds rate. Now, there's a couple of reasons why he thinks he can do this. One is that he's saying he thinks that AI advances and technology is going to increase productivity, which will then in turn be able to keep inflation low and keep it tame. So by these advances in technology, inflation will then remain low, which will give them room to cut rates. This argument may be a tough one to make to some of the other members of the FOMC board, but it's one that he has been trying to make. Uh, the one that's is interesting to me, and I can logically wrap my head around a little bit, is that by shrinking the Fed balance sheet, they're going to have room to cut rates. He's been on the record saying that when the Fed came in and did all these rounds of quantitative easing, it just benefited the people with assets while the normal American suffered due to this. So if you didn't have assets, you didn't benefit from the Fed's balance sheet expansion. So his idea, or idea that's in Wall Street that, what we're taking is the QT for rate cuts. So quantitative tightening for rate cuts idea. With this is that if the Fed reduces their balance sheet by a certain amount, that's equivalent to tightening interest rates or rising interest rates, which would then allow room for the federal funds rate to be lowered. Now, some some of the research out there has said roughly $1 trillion of balance sheet reduction would equal about 50 basis points of tightening. So let's say Kevin Wirtz wants to bring the balance sheet from 6 trillion where it's at currently down to 3 trillion. Uh, that would imply that they could possibly cut rates about 150 basis points from where they currently are, all else being equal. And those numbers are roughly in line with what a lot of research has been out there, of what the equivalence of $1 trillion reduction would be.
Well, and Matt, this is super unique, right? On because typically when you see Federal Reserve, if they're cutting the balance sheet, they're generally, increasing rates as opposed to cutting, right? In theory, or in the past, when they're printing money and, then they're reducing rates to kind of stimulate. So it's kind of a unique idea. Again, as you said, intellectually, you can kind of follow how this might work, that if pulling cash out of the system, intermediate and long-term rates in theory could go higher, right? And you can have a very steep yield curve. So in theory, if I can invest at 6 or 7% for intermediate and long-term bonds, I don't want to take the risk and maybe it'll be less inflationary. So it's an interesting idea, overall that you'd let the higher interest rate kind of curb the excess or, kind of the speculation within the market. So it'll be
Yeah,
interesting to see how this plays out.
definitely. Because in his testimony, he did say that a bigger balance sheet has become an ordinary recurring force within the markets, and that by the Fed holding a smaller balance sheet, he believes that interest rates could be lower, inflation could be better, and that the economy could be stronger with a lower balance sheet. So he's kind of already signaled all that during his testimony too.
Well, and
And
what'd be interesting is if this does play out to kind of, my expectation would be if short-term rates are low, that you could have a very, very steep yield curve. What's the impact of the housing market? What's the impact of mortgages within that, right? So you could see a rejiggering that you might have very short-term mortgages or other areas. Because again, I think there'll be an adjustment to, kind of this yield curve overall. But like I said, it's going to be an interesting item to play out. And typically, as you said, Matt, like when you get a Federal Reserve change, it takes a while for the markets to understand what this new messaging is, and there's typically a little bit of volatility around a new Fed chair, is your experience, isn't it?
yeah, yeah, definitely the markets like to test a new Fed chair. If you look back at both Yellen and Powell when they first came in the first couple of meetings, the market tested them. There was volatility. The messaging wasn't as crisp as it was when they were more seasoned as a Fed chair. So you do see some market volatility sometimes around the first couple of meetings, just as they get their messaging more in line. But going back to the QT for rate cuts, JR, also, I just want to kind of emphasize this point that, you know, Wirth has said that he prefers reducing the duration of the Fed's balance sheet and increasing some of the shorter term debt. So how this really does work is definitely going to be interesting. So if there is more coordination with the Treasury, maybe it has something to do with, hey, we're looking to sell some of our longer term MBS or even Treasury securities. How about we issue less longer term debt and increase bill and short term note issuance, which we would then kind of buy some of that, absorb some of the additional issuance you guys do as a way to do it. Now, to your point, this is all speculation and theory. How does it work in real life? Nobody knows. So I think in their mind, they could be, and their idea is that they can control the longer term rates this way by doing it, but who really knows in theory how it would really work?
Well, and the other potential advantage if this played out could be that the interest cost on the, 40 trillion of national debt could go down over time. If we're cutting short-term rates and you're shorting the duration, the borrowing that the Treasury would have would be, much less in theory. So that could be an extra reason to consider this.
Yeah. Exactly. No, that's where I think they're coming from too, is that just looking at a normal term structure of treasury bonds is that the shorter the term, the lower the rates, the longer the term, the higher the rates. Now, the one caveat I would say, JR, is that if you do enter a inflationary period and have too many bonds that are short term and you have to refi at a higher rate, that's the risk, right? But as of right now, that's the risk looks like they're willing to take because they do think they can control the short end of the curve a lot better than the long end, it seems like.
Let's
Uh,
talk about the makeup of the board, the Federal Reserve Board, Matt, going forward, and maybe some issues that, we might have on the horizon.
yeah. So Warsh has made his, policies and, what he wants to take the Fed pretty clear. He is officially going to be the new chair. He is just one vote, though, out of 12 on the FOMC board, which consists of seven FOMC governors and then five bank presidents, which is a rotating system. The big name on here that sticks out to me is Jerome Powell. So that's the former Fed chair as of today, actually Thursday. Now, he's sticking around and he said he's going to stick around until a time he feels is appropriate for him to leave. Now, as far as how him and Chair Warsh interacts is to be seen. Powell has, hinted that, he wants to be sitting in the background, not doing anything. But being the former Fed chair, he can definitely, sway some members because the chair's job is to build consensus and disseminate Fed view to the public. So is having Jerome Powell there going to affect Kevin Warsh's job? That is yet to be seen. But it's an interesting dynamic, I think.
Well, and Matt, when you look at, kind of the last year compared to maybe the prior like 20 years, I mean, normally when you get the results from the Federal Reserve meeting, it's typically unanimous, right? I mean, there's a handful of times, but over the last year or so, you've had a bunch of dissenters, with kind of the confusing picture we have where growth is good, inflation is higher than expected, labor is in between, overall. But looking forward with kind of this mixed board and, Powell staying on. I would imagine you'd anticipate, continued split vote on a lot of these Fed meetings ahead.
Yeah, listening to some of the rhetoric out of the different FOMC governors and presidents, they're all seem somewhat concerned with inflation currently. Um, and that's also going to be implied from a shift in market implied Fed funds rate. So now the first major test for Warsh is going to be that first meeting on June 17th. So back in February, market expectations were that the Fed would be cutting rates 2 to 3 times over the next 12 months. As of yesterday, the Fed implied Fed funds rate is showing a potential hike early 2027. So there's been a major shift because of that. And this is mostly due to the inflation backdrop that we're looking at right now. So here's a chart of the current inflation, CPI and PPI numbers. So as of April, the April inflation CPI year-over-year numbers, the headline came in at 3.8 with the core, which is the headline number less energy and food because those are the volatile sectors at 2.8.
Well, and
So
Matt, and this included skipping 2 months last year, as you've mentioned in the past, right?
yeah, and that will be made up eventually is how it works. But that's kind of what you're looking at. So you've seen a dramatic increase in the last couple of months on the year-over-year numbers. Both headline and core. The headline can be explained away through the shock in the oil markets due to the conflict currently in the Middle East. But core is also creeping up. So it's not just the headline number, it is also core. On the second chart below, you'll see the the last 4 months of inflation readings. What we did here, we just added them all up and then multiplied it by three to get an implied 1 year inflation rate by looking at the last 4 months. And then when you compare that to the current headline numbers, you can see that inflation is picking up. Once again, I'm looking at the headline number with a grain of salt because I don't think oil is going to continue to rip higher and make that headline number continue to go higher and higher. But the core is what's really concerning to me, and it should be concerning to the Fed. The last 4 months of core inflation is significantly higher than the year-over-year reading.
Well, on
So
top of it, Matt, when you look at PPI, which you have below, I mean, there's a problem, right? Will people in companies increase prices to offset this, or is it going to be a blip too, right?
100%. So in the very bottom chart, you'll see the PPI that was announced on Wednesday also. You'll see that both the headline and the core came well above expectations. So headline came in at 6% year over year when they were expecting 4.8, and core came in at 5.2% when they were expecting 4.3. Those are big increases that were not expected by the market. Now, the main question here, JR, is going to be, do these companies pass through the additional cost to the consumer, or do they eat them in their margins? Because if they do pass it through to the consumer, then you can expect, inflation to be stickier than first anticipated beginning this year, I think. So that's something to pay attention to. And only time will tell as we look at the data and then analyze the data too.
Well, and as you think about it, Matt, I think the market, you kind of give a pass in the month of March with the surge of energy and oil, right? And you kind of maybe figured it might be a month or so, but then April, inflation remained high and we're halfway into May and there hasn't been much relief. So the longer this drags on, in theory, the higher likelihood that companies are going to look to pass this on, and you could be in a even higher, inflationary environment over the next 6 months or longer.
Agree. Yeah. So that's, like I said, we're definitely watching this and paying attention to where rates are going and where inflation is going and how the market's, interpreting this and digesting all this information. And one of the big things we always look at is the 10-year treasury. This is the benchmark treasury note. So this is a chart from 2024 up until present, so about 2.5 years of figures. Uh, there's two sets of bands here that I'm really focused on. The first is going to be the Fibonacci retracement band. And these are the green lines and the blue line. So the blue line is a 50% retracement from the very top of the channel to the very bottom. And that comes in at a 4.2%. Now that number has been a pivot number for me for the last couple of years, actually. What I've seen and observed in the market is that when treasury rates are above that 4.2%, that acts as a floor. So, you'll see that the treasury, the 10-year treasury hit that 420 number, then bounce off it. And if it trades below it, it would often act as a ceiling. So when it would trade up to that 420 level, it would also drop back down to like a 410. Um, so that being the pivot makes a lot of sense looking at that the 50% retracement in the last 2.5 years.
And Matt, what does that mean generally as you're thinking about investing money, right? So in theory, as we're above 420 and the higher end of the range, maybe you're looking at a little bit longer duration and vice versa. If rates are at the lower end of the range, maybe you're shortening. How do you generally think about, you know, this to help with how you manage portfolios?
Yeah. All else being equal, that's exactly how I look at it. So when we start breaking up to the upper part of this channel, it would be a signal to, maybe add some duration. When you're at the bottom of the channel, maybe, shorten up the duration of the portfolios to protect against interest rate movements. You always have to look at why though. So it's not just plain cut and dry as, oh, buy here, sell there. You have to understand what's making these moves. Because right now we did break above that tighter channel and we're moving back to the secondary channel, which is about a 465 on the orange line right there. First thing we need to do is break that 450 level, which is more of a psychological resistance in my mind. But if we do break that 450, I wouldn't be surprised to get to 460, 465 real quick.
So Matt,
Um,
as you take a step back, right, you just looked at those inflation numbers and you look at the trends of things, in theory, why aren't rates dramatically higher, right? Because again, given where we are and where things are, you'd expect, to really break out. And nonetheless, we've stayed kind of in this range.
yeah, I think the big thing is this administration has vocally expressed their desire to keep rates low. So people are very hesitant to maybe take it to the next level because of the worries of what they could do to then, bring yields back down. So it would have to be some kind of a meaningful issue, I think, to break through these levels. Or either that or the markets just, stop thinking that this administration can control lately. they currently think they do. So that's my assumption right now.
Or
Because
maybe they just really expect inflation to come down dramatically and this is temporary, which, is a view. I don't know that we necessarily agree with it right now, but I guess could be another reason.
yeah, and if you expect right now what you've heard a lot from the even Chair Powell in his last meeting and other Fed governors and just a lot of market participants is that they're expecting that the effects from the tariffs should be rolling off right now. So inflation in the second half of the year should be coming down because the tariff effect is no longer there. That remains to be seen in my mind. And I do think that we should have a better, clearer picture of inflation, come the end of the summertime. And if it's really that sticky, you could see a nice move up in rates possibly at that point. But
Especially if he's reducing the balance sheet too, right?
yeah, and that's the one thing that, any reduction in the balance sheet, I just have a hard time seeing happening before the midterm elections. Not to be political or anything, but I just don't think that's something that Warriors would want to do before midterms. It'd probably be a next year kind of an issue in my mind. So, but as always, the big question is how are we investing in this environment? So, this is the current Treasury curve. Now, we're maintaining our position on investing and deploying capital into our intermediate barbell strategy, which is, essentially roughly one-third of the portfolio in short-term debt inside 2 years, one-third of the portfolio in the intermediate part or the belly of the curve, and then the remaining third, selectively looking at relative value opportunities that give us the best risk return scenario. Now, this strategy has performed exactly how we expected and has led to, outperformance over the ag this year so far. With new money coming in, either be maturities, we have a good chunk of bonds maturing in the next couple of weeks, or interest rates being paid out, just new cash coming in the portfolio. We'd probably start favoring, longer part of the intermediate strategy. So looking more in the 7, 8 year space, because we do think, the pickup you're getting here versus the short end is significant. You're picking up, with that plus the credit analysis we do. We do think that we can, maximize return while minimizing risk still in this environment. The one thing we wouldn't be looking to do quite yet is going out 30 years. That's one part of the curve, which we just don't see the risk reward in our favor right now. But, 7, 8 years, we do think there's some good opportunities there where you're getting, well, pretty good above market returns as long as you do the work.
Matt, how do you feel about, kind of credit risk? Obviously, you had the Spirit Airlines default, but I mean, we had really good corporate earnings, I think, overall. But what are your general sense as far as, risk of defaults in this environment currently?
There's it depends on what sector you're in, right? I mean, everyone's talking about software and some of the issues going on there with AI coming in, potentially disrupting that space. So software companies with large debt issuance, I would definitely look to avoid probably right now, just from an interruption basis from AI. But overall default rates are not too bad. On the private credit side, it's a little bit different. There has been, some relaxing of covenants and some of these things. That's nothing we're involved in. We stick mostly to the public markets. But overall, credits are fairly good. But it's also reflected in some of these credit spreads. Credit spreads are still pretty tight historically compared to where they've been. So it's really being selective and doing your analysis and trying to find the best risk reward that you can because spreads are not overwhelmingly wide versus where they have been historically. They're actually very tight. I guess with that, we'll kind of wrap it up and say that new money coming in. There's definitely opportunities out there. We do like this intermediate barbell strategy. It's done great this last year or two and really produced significant alpha for our investors.
Well,
Uh,
and I think, Matt, as you said, I think, well positioned from the standpoint, if there's volatility around the new Fed chair and yields do jump, the flexibility to take the short term, and take advantage of some of the opportunity or vice versa. So I think, well positioned to kind of either way interest rates go over the next quarter or so and reposition as always.
Yep, I agree. Yeah, and that's a strategy and it's been working really well. So I'm going to keep with it.
With that, I want to thank everybody for listening and touch base next quarter.
I guess with that.